Okay, so guys, let us start with practice question number 11 from your study mat on investment decision. Now, this is an example where you have been using an old machine and the question is whether you should replace that with a new machine. Now, let's go ahead and take on this question. Yes.
So Zavli Limited has a machine which has been in operation for 3 years. The machine has a remaining estimated useful life of 5 years with no salvage value in the end.
Okay.
Its current market value is 2 lakh rupee. The company is considering a proposal to purchase a new model of machine to replace the existing machine. The relevant information is as follows. Cost of the existing machine 3,30,000, new machine 10 lakh. Estimated life 8 years and 5 years. Salvage value is nil for existing machine and for new machine 40,000 rupees. Annual output 30,000 units and 75,000 units. Selling price per unit is 15 in both the cases. Annual operating hours also is 3,000 hours in both the cases.
Okay.
Material cost per unit is rupees 4 in both the cases. Labor cost per hour is 40 for existing machine and 70 for new machine. Indirect cash cost per annum is 50,000 for existing machine and 65,000 for new machine. The company uses return on value method of depreciation at 20% and it has several other machines in the block of assets.
Point to note. So you guys are going to follow the income tax approach, right? Block of assets. It's given there are other machines in the block. Next.
The income tax rate is 30% and Zavli Limited does not make an investment if it yields less than 12% per annum.
Now that is supposed to be the cutoff rate or the hurdle rate. 12% is a discount rate to be used to calculate the net present value of the project.
Now advise whether the existing machine should be replaced or not and PV factors at 12% for 5 years are given.
So whenever there is a question on a replacement decision, now where they given the data regarding the old machine and the new machine and it's a replacement decision to be made, we follow something called the incremental approach. That is, we are supposed to calculate the incremental cash outflow at time 0, there is the initial outlay.
Yes.
Also find the incremental operating cash flow from the machine as compared to the new machine as compared to the old machine, right? And that is the way you're going to go forward. Just see the solution out there. The first working is relating to initial outlay. So it's given that the new machine will cost your company rupees 10 lakh. It's also given the old machine that you have already 3 years used, right?
Yes, sir.
So it has a market value of rupees 2 lakh. Now 2 lakh is a cash inflow. So you want to buy a new machine for rupees 10 lakh cash outflow. And 2 lakh is the amount you get from selling the old machine. That's a cash inflow. So what is the net outflow?
Eight.
It is
8 lakh.
8 lakh rupees. Okay.
Yes, sir.
It's not outflow, it's outlay.
Outflow, yeah.
It's outflow or
Outlay.
the initial outlay. Okay, guys.
Yes.
So you can have a laugh. Okay, at me. So it is 8 lakh rupees a cash outflow. Right?
Yes, sir.
So that is time 0. Now next step is I'm going to calculate what is the WDV of the asset base for the purpose of calculating depreciation. Is that fine?
Yes, sir.
Yes.
So calculation of base for depreciation.
So what you should do, we know we bought the old machine for 3,30,000 3 years ago. It has a 8-year life and all.
Yes, sir.
3 years over, another 5 years to go, right?
Yes, sir.
So 3,30,000 on that 20%, how much?
66,000.
Exactly. For the second year, what you should do? From 3,30,000 minus 66,000 on the balance 20%.
Yes, sir.
How much?
I'll calculate.
It is around 50.
The amount is 52,800.
Wait, that's what you'll get.
Yeah.
From 3,30,000 minus 66,000.
Yeah.
On that amount, you take 20%.
2,64,000.
You will get 52,800. Then again from 2,64,000 minus 52,800.
2,11,200.
And on that you apply 20%.
42,240.
And that will be the depreciation for the
Year 3.
the third year, right? So if you minus all the three numbers,
1,61,040 we subtract, we
It
get WDV of the existing machine 1,68,960.
that is after 3 years. That is as of today.
Yeah.
3 years gone by already. Okay, at the end of year 3, we have this much value.
Yes, sir.
Now let's find for the new machine, right? What you should do, you want to buy a new machine for rupees how much?
10 lakh.
10 lakh. You already have an old machine worth how much? 1 lakh?
68,960.
Add both.
Yes, sir.
Minus, you want to sell the old machine for rupees 2 lakh. Exactly what you do in block of assets in income tax.
Yes, sir.
We take the opening WDV and then add any additions to the block
Yeah.
and minus the sale proceeds. So which is 2 lakh. So net amount how much?
Net amount is 9,68,960.
That is the base on which you're supposed to calculate depreciation. Is that fine?
Yes.
But remember, we are going to calculate on the incremental amount, right?
Yeah.
So what you should do, 9,68,000
960.
minus 1,68,000,
960.
and that is a incremental amount on which we'll be claiming 20% depreciation.
Yes, sir.
Understood? So we're going to compute even the depreciation on incremental basis. So what is 8 lakh?
It is a base of incremental depreciation.
Exactly. Or what if you want, you can do it separately. On 1,68,960, right? On that 20%. Then on 9,68,960, 20%, then take the difference. That's not worth it. Okay.
Yes, sir.
Instead, you can take the incremental and then calculate the depreciation. Now we go to the next working. What is it? We want to calculate the
Annual
operating
profit.
cash flow. That is annual CFAT. Okay, that is incremental cash flow, right? He has made a table. So particulars, and then you
Existing
have
machine,
existing
new machine, differential.
but focus on the difference, okay? That is the number we're going to take later.
Yes, sir.
Now just see output is 30,000 units and 75,000 units. And sales value will be into 15. So 4,50,000.
And 11,25,000.
And the difference how much?
6,75,000 rupees.
Then comes all the costs, all the cash operating cost.
Yes, sir.
We have amount spent on materials.
4 rupees.
30,000 into 4 and
5,20,000
75,000 into 4.
3 lakh.
The difference.
1,80,000.
And then wages will be 3,000 labor hours into
40.
into 40.
1,20,000.
3,000 hours into 70.
2,10,000.
So incremental labor cost.
90,000.
Then indirect cash cost, example rent, salaries and blah blah, right?
Yes, sir.
How much? 50,000?
65,000 and
difference.
15,000 difference.
That's it. Now what do you do? Balance
Total.
if you want, you can balance the two columns. Okay, that is a total operating cost and get the difference.
Yes,
Okay.
sir. Total cost is 2,90,000, 5,75,000 and 2,85,000 difference.
But these are only cash cost. Okay. And then you get
Profit
the
before tax and depreciation.
Exactly. PBDT. So how much existing?
1,60,000,
New machine?
5,50,000,
Difference?
3,90,000.
That's it. Okay. So once you get the 3,90,000, it's going to be for all the 5 years.
Yeah, the difference.
Nothing given. You're going to enjoy a 3,90,000 PBDT for all the 5 years. Now just see, they made one more table. So the incremental PBDT for each year 3,90,000, no doubt. From that less what? Depreciation, the D. It will be for the first year how much? On 8 lakh rupees incremental, apply 20% to 1,60,000.
Yes, sir.
For the second year, what you should do? From 8 lakh, subtract 1,60,000.
6,40,000.
On that, apply 20%, 1,28,000.
28,000.
And do that for year 3, year 4,
Yeah.
year 5. Is that fine?
Yes, sir.
And once you get PBT. And then on that, apply what?
Tax
Income
rate.
tax 30%.
Yeah.
Okay, on that amount, apply 30%. For example, for year 1, 3,90,000 minus
1,60,000,
exactly.
2,30,000.
On that, apply 30% tax is
69,000.
9,000 is subtract. Do that for all the next 4 years, right?
Yes, sir.
And then now how to find the PAT is nothing but what? From 2 lakh and 30,000 subtract 69,000. What is the balance you get?
We get 1,61,000.
And so on for all the years, right? That's a PAT. Then what you should do now, you should add back.
Depreciation.
Exactly. That's what is given as, what is that? 4
minus 5 plus
minus 5. 4 is a profit before tax. Minus 5 is what? Income tax is subtract. Then add back depreciation.
3. Yes.
Right?
Yes, sir.
Yes? Basically, what happens? 2,30,000 minus 69,000. But add 1,60,000.
So 3,21,000.
That's it. And do that for all the years, right? And now you can discount all these
At 12%.
cash flows at 12%. You'll get the present value of all the incremental cash flows.
11,06,200.
Then also add at the end of year 5, you'll be able to sell the new machine for 40,000 rupees, right?
Yes, sir.
So 40,000 salvage value, that into
0.56.
the fifth year factor. You multiply, add that also, you'll get the total PUF cash flow including the salvage value minus the initial outlay. How much? 8 lakh rupees incremental outlay. So what is the net amount?
3,28,964.
And that is a positive
NPV.
net present value. Therefore, it is worth
Investing in the
new machine. Please throw the old machine. You can sell the old machine for 2 lakh, no problem.
Yes.
Understood?
Yes, sir.
So please remember, whenever the data regarding old and new machine given, and it is a question on replacement decision, then you are supposed to follow which approach? Incremental cash flow approach. Is that fine?
Yes, sir.
Okay, guys?
Yes, sir.
So good luck for examination. Just go through this sum.
Thank you, sir.